Okay. Okay, I can confirm that I am live streaming just now, and I am just gonna prepare myself and my presentation while waiting for folks to come in. So please give me a couple more seconds, and I'll get set up so that we can get rolling. Okay. And before I go, I'll just go to Threads and give a shout out that I am live just now too. I am. Okay, and then we'll get ready. I know you guys are here on lunchtime, and I'll make sure that I'll give you guys a good presentation. Okay, 1 minute. I am still setting up here. How's everyone today? I hope that you guys are having a good afternoon on a Thursday. I am here in London sharing this information today, so see where we're gonna drive this growth. Okay, 2 seconds. Okay, so today welcome to Family Investments. So today's main motto is driven by you guys from Threads. They're asking on how to build that growth portfolio. So building a growth portfolio is it's important because end of the day you're here to beat the market. If you're not beating the market, meaning the Nasdaq, which is one of the highest growth index in the world, and that means you are lagging behind. And you don't need to be a trader, you just need to be an investor, and you need to stick to systematic investing. It is what I want to share with you today, because at the end of the day, you want to sleep well while knowing that the business that you invest in is good. But there is a tweak in the system that not many people speak about, and I've done it for years. I've tweaked, refined it, I've shared with my club members, and today I want to showcase to you guys for the next 30 minutes. Okay, and yep, I will switch over now. Okay, so this is again thanks to you guys on Threads that's asking for this, and I'm here to share. This is my raw edition. This is something that I've developed over the years, and it's worked with folks that I know along, friends that I know along. And it's worked for me. It's something that I go on as well. So today there's two elements. We're focusing on the growth. What gives the growth, and what style of portfolio will give the growth as well. Okay, and this is very raw. This is not something off the textbook stuff that you see. This is off the years of preparation of myself, the portfolio that I manage, and the people that I've helped along the way. And today I'm just gonna squeeze all the good juice and give it to you guys. The most important thing with the Real Deal edition, okay, is not about getting it right. It's about staying ahead of the pack, okay? Nobody can predict the market. Nobody can know what happens tomorrow. The only way you can do is to be less wrong, to be staying ahead of the curve, okay? And in the contents that I'm going to share with you today, which is a bit off the screen, is I'm going to storytell the truth, the risk, okay? And because of the time permission, I only can show you the type 1 and type 3. If I need to show you the other types, we're gonna be here for an hour. But for lunchtime for you guys, half an hour with Q&A at the end, which I hope to attain. Okay, and I'm just gonna go dive straight into the conversation here. So I just want to share with you guys. Me, I'm nothing special. I'm just like you guys. You know, we're all here trying to make it great for our family. We just want to invest, enjoy our holidays, spend time with the families, watch your kids grow up, you know, spend time with your mom and dad. There's nothing special, but this investing has made a game changing for me and many people around the world. And today I hope to share this story to inspire you guys, because it's not far gap that we can reach that destination to build that wealth while you are sleeping, especially the element of growth portfolio, which is so important, or else you're just wasting loads of time if not done right. So I might as well tell you just now. And the thing that everybody gets wrong about a growth portfolio, okay? I'm going to go with this everyone, okay? Everybody thinks that what you see online, it's all about going all in, retiring early, and it's like a lottery. The all-in Tesla investor, the all-in Netflix. You hear that stories, but you do not hear stories of people that's actually failed, that bought a specific drilling oil stock or a specific pharmaceutical company that went from 100% to minus 99%. You don't hear the stories. So it's easy to listen to people that just got it right. Yeah, because they're on the news and everything. It's like a story, it's on the movies. But there are hundreds of stories, thousands of stories that you don't hear about. But us, as members, or you guys as followers, for me, and the things that I want to share with you guys, it's not about getting it right, but it's about getting it less wrong. It's how can we set our own growth stock over time, manage it as minimal as possible while the business is running. Because at the end of the day, you're not running the business. You're just investing. You're selecting your fantasy team player. You're selecting your CEO. You're not running the business. So why do you have to spend all your day scrolling and refreshing to see what's there? So you need to be less wrong by picking the right or the better growth stock. Okay? And one thing that's clear to everybody that I want to share, it's easy. People say, oh, you buy a stock, if it goes down, buy another one. Okay, and choose another one. But you forget that our maximum earnings, our lifetime, you work 9 to 5, I work 9 to 5, and people work 9 to 5. Our parents work 9 to 5. And the max capacity from working at your peak, like footballers at your peak, is 15 years. It's the age between 30 to 50 where you earn your maximum peak. That's when you can save the most. That's when you can invest the most. And if you keep making mistakes over this period, you are goose. Imagine reaching 51, 52, thinking, okay, I'm going to start investing now. What am I going to do? But you're hitting your peak career. Your growth in your salary will not go any further. And by then, you should be thinking about retirement, and the compounding effect is very, very low. So all I want to share to everybody is make sure you peak at your prime, and your growth portfolio needs to be set in place. Okay, folks? Folks, look, this chart here, if you Google the best investors in the world, you got the GOAT, Warren Buffett, and you got many other people. And I can assure you that the style of investing is completely different. Ray Dalio, he invests maximum 10% in his stocks, and Ray Dalio stick to the rule book. Warren Buffett, he buys stocks that are cheap, but when he goes all in, he goes huge, big, okay? And then you've got Jeremy Grantham here, who is so speculative, and he hates growth stocks. He likes defensive, and he's always shorting any growth stock. That's how he makes his money. So all I can say is everybody here has got a different style portfolio. Okay, so you do not need to be as them, but the only thing that you need to understand is you will not be like them. Why? Because these people are fund managers. They manage not just their own money, but they manage other people's money. You and me, we only have funds to buy because of our salary that we save every single month. And if we run out of those, we cannot buy the freaking dip. So we have to manage the portfolio, manage the risk different from these guys. So do not worship these guys. These guys are nice stories, they have a nice suit, but they have unlimited cash to buy the dip, and you and me do not have. And put that in your mind. Okay, guys, that's the truth that I have to just strip the band-aid for everybody. Okay, now this is a very, very important element here. How do you build a growth diversification? I call this, sorry to be flipping screen, it's the pyramid method. Okay, the pyramid method is the one I share to simplify, to make it easy so that I can explain to somebody else who's got zero clue, and in 5 minutes he or she will go, damn, that's easy. Okay, you can simplify things. E equals to MC square has been simplified. Half plus times base times height has been simplified formula. So I want to simplify the portfolio diversification so that we can build a growth. So for me, I create 4 different levels of stock. From the bottom, the most important is the staples, cash and ETF. Staple stocks are stocks that are already slowly growing. They pay dividends. They're stable. The Costco will always be around. Okay, the Walmart will always be around. Okay, the Apple are slowing down, but the dividends are coming in. People are still buying their Apple iPhones. These are the staples. Your NASDAQ, your S&P 500, your FTSE, your cash. are classified as staples. And if you build from bottoms up, you build from the base. You do not build a pyramid with the top. You build from the base and you move your way up if you are starting from scratch. And this is 40% in comparison to the rest, and it's very, very important. Why? Because if your stock falls, this is your most defensive ground. It holds you down. If there's a flood, this flood holds your pyramid in place. Okay, I cannot stress that. And then for your mature growth, this is where you put 25% allocation here. 25% of mature growth. What is mature growth, Alex? Mature growth are basically stocks that are over 10% growth. To keep it easy, you're asking me, Alex, what example of mature growth? Easy. The Mag 7. You got your Facebook, you got your Amazon, you got your Google, iClass, Nvidia as mature growth. I know they're exploding just now, but these other companies are making billions. They're generating over billions, and they're still growing. The Netflix are still generating cash, and they've been around for quite a while. And you can have your what other stocks can I say? You know, you've got your other mature, you know, your defensive, your Caterpillar, your Lockheed Martin, you know, your Louis Vuitton. They're still generating growth, but they're slow growth just now. They're not going to explode like with the younger days and go 10x, but this will slowly creep over time as the economic growth, and it will always beat inflation. 25% here, and you're fine. And now this is the element of the second two segment, which is key. The high growth stocks. High growth stocks, you have to put 25% equivalent. These are the stocks that can still go 2x, 3x, 4x. Okay, depending on how long you hold, 10 years, it could even creep up to 5x. These high growth stocks are companies that are already making profit. Company that generates 25% growth. You can go Yahoo Finance or your trading fool. You can check them out, and you can see those step ladder growth that they attain, and they need to grow. Okay, there's some companies that stop growing. Okay, and then you don't put them there. You make sure the companies are still forecasting for growth. Again, you're asking me, Alex, what type of stocks? We're talking here about the Uber. We're talking about the Robinhood. We're talking about the SoFi. We're talking about the Palantir. These are the stocks that are already profiting, and they are growing, and they are scaling. Scaling is so important in this segment. That's how they grow. The companies, they'll hit a peak. They do not grow anymore. There are companies that you think they've stopped growing but are still growing, like the Eli Lilly, the Novodesk. They might hit a road bump because of the presidential change, you know, the healthcare system change, but they're still growing. They're still increasing capex investment to push it even higher. 25% there, very confident. This is the real growth driver in the entire portfolio, and something that you should consider. And the last but not least is your risk management, or I call it the high risk stock. Here you can buy any monkey, Tom, Dick, any stocks, you know, crypto, any funny stocks, penny stocks, you can go. But why? Because you need to take a bit of a risk. Okay, you've already been defensive down here. 10%, only 10%. Okay, you can buy your crypto, your funny coins. Okay, why? So you can sleep. How? If this investment of complete full 10% goes to zero, let's say you buy a meme coin. Okay, you buy the penny stock or the pharmaceutical stock that your friend told you that was great, and guess what? 6 months later, whoosh, came down. But if it comes down, you never know. If you knew it, you'll be a millionaire by now, okay, or billionaire by now. But nobody can predict. So if this 10% goes to zero while you are sleeping because you did not know that the news is happening, it caps your maximum loss of your overall portfolio by 10%. Okay, 10%. That's the max loss. But what if you buy that particular stock and it goes 10x? Okay, that stock that nobody even knew. Okay, let's say the Orb. You bought Orb. It went 4,000% in a day. Okay, 40x for you. And guess what? That thing has bloody bloated up 40 times. You take profit. You run. You start spreading across the border. Start spreading your seed, or go pay off your mortgage or pay your loan somewhere. But this has the limit of the upside is limitless, but the downside limit will be capped at 10%. Okay, this is important. I hope that everybody captured this before I move into the two-type style of growth portfolio. Okay, and before I go to the next part, guys, feel free to put queries and comment at the end. It's important because you're going live, you see me, and I'm here to answer questions for you guys as well. So it takes that lunchtime a bit more worth a while. Okay. Now I'm going to go into the type 1 and type 3. I'm going to skip type 2 because of time constraint. I need to make sure that you guys' time are very precious here as well. Okay, let me start with the type 1. Okay, the type 1 is a favorite, is the basic one that people do, and unawarely they do this. And this is something that if you are an MBA student or you studied some finance, this is the 10% rule that people naturally play out, and your financial investor will tell you the same thing, but I want to tweak it a bit for growth. Okay, so any stocks that you own from the pyramid, okay, the maximum allocation that you have with your profit is 10%. So let's say you bought Apple back in 2016, you bought 5% of your portfolio, and Apple grew 5x. So 5%, you grew 5x, you'll be hitting about 25% allocation, okay, 25%. And then when you hit 25%, you put under 10%, from 5% Apple, it goes 25%. Because of that growth, because you 5x, then you start trimming them to make sure it doesn't go over 20%. So you take your profit of 5-10%, and then you buy other stocks. Okay, you buy other stocks to allow growth. You're replanting new seeds, and then your portfolio that starts growing, and then that reduces the risk. The only thing is, as a retail investor, that if you do this type of rule where 10% it goes up, 20% you trim. Palantir is one example. You bought it 2 years ago. It went up 5x. You trim it, and then you buy some other stocks like Robinhood or something else. You might end up, the disadvantage, you might end up managing many stocks, and then you might end up watching every single earnings that you need and follow every single stocks. It's a bit tough, but if you keep that rule of 10% maximum, then you cap your also maximum risk for a single stock. But the upside can be reduced as well. So I would always, in this allocation, the difference I would do is I'll focus on company that's still growing. Rather than too many dormant, slow stocks, you focus on the ones that are growing. Don't buy like the BMW or the Chevron, BP, Shell, or the mining stocks that are generating so slow. Go for the more aggressive growth, but still making cash, like the Ubers, the Robinhood, your Nvidia, your AMD, your TSMC, your ASML. Those companies are generating growth. Okay, so you keep up the trend, make sure you don't overbuy a single stock, and then that's your growth, and it's easier to manage for you. For who does this type of stocks, okay, the person that does this type of stock is Lynch. Peter Lynch. You hear about it every time. He owns this type of stocks. Okay, he owns stocks from every different one, but he never goes over that 10% rule, and he makes sure he owns a lot of them because he wants multi-baggers. Okay, he's got money that he wants to put little pockets everywhere. So if you're the type that wants to own everything like a Pokemon collector, this is the style for you, and it is not wrong, guys. It is not wrong. So this, what is do? So again, maximum allocation 10% when you start maximum. But if you want to build portfolio, go 5-6% because you need to give them room for growth as well. You don't want to trim too early. But you want to own different stocks. For example, you got like, Alex, I like cyber stocks. I couldn't decide between CrowdStrike, Palo Alto, Net, and a few other that came on the radar. I don't know what to do, Alex, but I think cyber security is the big ones, and I want to own them all. Fine, go 2% on each, and you buy 5 stocks, 10%. Okay, and you got 2% to 8% growth is possible. So that's what you do. If you're the type that wants to own a bit of everything, there you go. There you go. And some people want to do it because, every month. Let's be realistic, yeah. You do a 9-to-5 job, you got mortgage to pay, you got kids, stuff, football and stuff to pay, your daughter's piano and ballet. You're not gonna have excess cash. You got a couple hundred, 200, 300. You want to buy a bit of everything. So that's where you go. So you make sure that you don't miss out. That's a style. If that's your style, this is the one for you. Just be ultra realistic with everybody here. Okay, we're not Peter Lynch who can just do a bit of TV talk and he got another $5 billion invested in him. No, we're not. We need to be realistic, and this is one of the most realistic one for many people. But when it goes to 20% trim, high risk, again, more high growth. Mature zone starts holding. When I say mature zone start holding, what I mean is, if you go back to this thing, if your stocks grow, and it over 5, 6, 7 years, it goes to mature zone. When you hit this zone, then you start holding. There's no more reason to trim. People who owns Meta back in 2012 was a high risk stock. It grew. People trim, buy it, grew. Trim, buy. It comes to a point where it hits this mature growth zone. Yeah, if Meta, Facebook hit this growth zone, why? Because they're paying you dividends. There's no reason to sell them anymore because you want to hold the number of stocks to grow in the dividend sector. So that is the rule. The mature zone, then you start holding, and then you will have 20, 30, 40 stocks to manage. But then with the protocol we have today, that we can own partial stocks. Robinhood, you're trading 2-on-2. You're in Asia, the Webull. So when you own this type of stock, it's okay to own because you can buy partial shares now. You don't have to buy a full Tesla. You can buy 1/4 of a Tesla share if you're $200. So it's okay. This is a sizable portfolio, and this will beat your ETF. Okay, this will beat your index. This will beat your VOOO if you pick the right stocks. Right. Okay. Most important part, that growth needs to be more than 40%. Okay. So what to expect when you build this type of portfolio? You will be doing more fundamental analysis. You're not doing technical analysis because you're not a trader. You do not care about when you dollar cost average when you can. Fundamental analysis. You see companies that work, companies that will last 10, 15 years, things that you look around. Okay. You might be in Singapore looking at Grab, saying Grab is doing so well. You might be in America saying Uber is doing so well. You might be in some parts of Japan or Europe because Lyft is doing quite well. So you're more like fundamental analysis of what you see, what you buy, and what you think you want to apply to. You may go, Disney has just increased its bill, it pisses me off, I'm going to dump Disney, and then Disney Parks is reducing. So you end up being more fundamental analysis looking at these numbers. I would say it's CAGR or compounding rate. I would expect this type of portfolio to grow 15%. Your index will grow 9% average over time, but this will grow 15. So you're almost closely to double that style of growth. Okay, and this portfolio style is very defensive, and you end up being buying orientation more than selling orientation. Why? You end up like business owners because you buy a little bit of different high quality companies, and this is the way to diversify, and this is the way to control your risk. Okay. Next. Okay, so we're halfway through. Okay, not halfway through, but I guess 2/3 through. But before I go there, I would like to showcase a bit. This is for me to showcase my platform. Okay, to showcase what I do as the Buy Triggers here. So on Buy Trigger, I run a Buy Trigger website. Okay, I run a club for everybody. I forgot my own Buy Trigger Club. I run the Buy Trigger Club on buytrigger.blog. This is where I bring investors in. People who work with me. I've got this database that I share with everybody, and the Telegram app that comes every single afternoon. What's on Buy Trigger, what's on Value Trigger. Because end of the day, Buy Trigger is about understanding that you dollar cost average, you got sizable amount of money that you have. What do I buy now? You don't just buy random stocks because stocks are on high and low. So you focus on the quality ones that is the great price at the great time. So the information I share with my members is, I open up this database for everybody to search, and at the moment I think we're close to 100. I'm aiming to hit 120 before Christmas. Only quality stocks. I'm not going to bring any Tom, Dick and Harry's type companies. Only quality stocks that I vet. Okay, yesterday we were vetting lots of stocks. I had to reject a few requests from the members, but I have to be realistic because I have to protect and be defensive on everybody's portfolio. And I have got a back-end database that I run with, and in the club I also share another web app which I'm building for everybody. It's got calculator, it's got the pyramid diversification tools, it's got news, and it's got calculator. This is what I'm building for the club. And guys, feel free to come in the club we have got chat forums, we have got articles that I release. You guys, the things that you guys see on threads is basically I share 80% of stuff for free, but 20% of my most focused time I come and chat to the communities. I do lots of live. Okay, I do live at least twice a week. Okay, I have got lots of previous live video that I share with folks, and I do lots of macro and discussion. What's the hottest topic? This is where I am. I no longer come on YouTube because YouTube, the problem I have with YouTube is I have to clickbait. Okay, to get you guys in to watch my YouTube videos, I have to clickbait. When I go on Buy Trigger, I go straight into the facts. No clickbait about crash, there's top 5 stocks to buy. I just give you guys straight the plain facts. Okay, when it's not time to buy, I tell you. When it's time the market is going hot, I tell you. I do not have to waste my time tricking you guys, clickbaiting like every other YouTuber has done, because I am an engineer. I talk about data and facts. So guys, join the Buy Trigger Club if you fancy. If not, follow me on Threads. That's where I focus my public content. If not, my weekly Monday newsletter. If you want to go there, alexco.me is where I do. So I presume you guys are on there. If not, sign up. Go to my bio link. Okay, So let's go to the next one. This is what I do with my portfolio. But before that, let me get a drink of water. And guys, get your questions ready when I turn. Hope to get some questions and help you guys get into the groove. Okay, this is my style of portfolio. Okay, at the moment I'm up around about 30%. Okay, 30% is what I'm up, and this is my style. And back in 23, I was up over 90%. 24 last year, I was up over 90% as well. And every other years, I've always been beating the market. Okay, I don't even have to keep track anymore. I just have to focus on this method. I've always been beating the market. I've been on social media since 2019 is my YouTube. I started writing a blog since 2015. I've been here while I've refined, and this is what I share with everybody. So this is my style, and my style is not my style. I did learn it from the gurus as well. Top 3. I buy top three stocks over 70%. So my stock A, stock B, stock C are over 70%, close to 70%. That's my goal. Okay, I focus on growth. I focus on company that will be growing with 25% at least for the next 10 years, meaning 5 years before and 5 years in future. Okay, that's the forecast that I work on. 5 years of established data, 5 years of future data, 10 years. Okay, I'm not talking about just 2 years growth or 3 years Duolingo growth. I'm talking about solid growth business that we can see 25%. And PEG ratio, just to be clear, is between 1 to 2. I need to make sure there's still good value. I'm not going to buy overvalued stuff. Okay, dude, I mentioned I don't pay extra. Okay, I pay for bargains. Okay. And also gross margin needs to be 40%. Okay, that's the very simple terms, but I will show you how well this type portfolio will do. Guess who? Warren Buffett's style is this. I read his snowball effect, and it's by coincidence I noticed, and nobody speaks about it, that he always owned more than 70% on his top 3. Okay, 60%, 70%. So he Apple, Bank of America, and Chevron. This is what he has now. This is his concentration top 3 portfolio. Okay, people make fun of me, say, Alex, you own lots of Nvidia, but dude, this guy owns lots of Apple. I mean, he's holding it. He knows he's holding it. Why? Because he knows that the company was growing and now they're paying dividends and they're still selling phones, regardless of all the AI and all the garbage. He knows that Apple has got cash revenue generation to rock the market, even when they come a bit later. That's how we invest. That's how we buy companies that's going to be sustainable. Bank of America is not going to go down. Chevron's not going to go down. Oil is needed. He was right. We laughed when he was buying oil back in COVID. And guess what? Data centers coming. We need more gas. We need more oil. We need those energy, folks. Peak oil is not over. Peak oil is coming even higher. He knows. Top 3. Did he change his portfolio every single often? No, he never. He buy. That's what you do. When you choose 3 of your top horse runner, you buy. You DCA, you BTFD. When there's high VIX days, when stocks drop, you buy. Okay? When you buy, when you go like, I got cash, send line, oh, market's gone red. Oh, what do I buy first? There's only 3 of that stock in mind. Okay? Some like to choose 5. You got 3 of that stock in mind. You got 3 of the buy trigger ready. Okay? Simple as that. That's what I do. Okay? For me, my top 3 stocks is Nvidia, TSMC. At the moment, sorry, I'm trying to find the camera. At the moment, I've got Uber as number 3. Okay, I had Robinhood as number 3. I've sold Robinhood. I bought more Nvidia. Why? Because Nvidia dropped to buy trigger, and I know that Nvidia will not be 111 no more. Nvidia dropped to 90, 85 for a few hours, back to 90, 95. However, a couple of weeks, I sold all my my Robinhood, went at 10x, and bought lots of Nvidia. So I've grown almost as much as what actually grown Nvidia by 65%, because that's how we roll. We focus on the companies that we buy. Okay, growth needs to be 25%. It will decline at some point. More than 25%, it will decline at some point to rock to 15%, but it's still there. Microsoft is close to 15%. Facebook dropped, and now as Facebook's bounced back up again. It's easy. You buy that 3 racer and you keep it for decades, my friend. I bought Nvidia since 2015, 16. I bought it for my kids, Nvidia, since 2016, 2017. When COVID came, we sold a lot of Apple to buy more Nvidia. So that is how. I didn't pick Nvidia from yesterday. That's some people's confusion. I picked Nvidia for a while. Yes, there are periods where we have completely dumped it and come back out due to all this cash protection regime. But first, it's always buying. My Nvidia is always be there. Okay, I used to be like Mr. Buffett on Apple from 2015, 16, 2012 when I bought for my kids, all the way, and I actually owned Apple before Buffett owned Apple, and then I switched both after COVID from Apple, Tesla for a short spin, and then eventually went Nvidia. I've got it all proved on my YouTube, and that's how we roll. Okay, it is not stumbled by accident, but it's based on your fundamentals. Cash generation, high buybacks. I like that type of stocks within the top 3. Stock splitting is what I like as well. When a stock split means they raise cash, means they're looking for growth. And look, Nvidia, Apple, $4 trillion companies. Even the likes of Netflix, stock splitting. And I like my top 3 to be in the consumer market growth, meaning the customers are you and me. Okay, I know I cannot hold the top 3 stocks which have like defense sector or Palantir which buy contracts or companies that needs client from enterprise. It's very hard for me to own this because I cannot see those type of growth. Okay, it's like, you know, Singapore is buying more Airbus and Boeing, but I'm not the clients. I wouldn't see that, you know. Or defense company, NHS signed with Palantir, I can't see that. And so I don't own those type of contract type as my top 3. I prefer consumer market growth that I can see, like the Netflix, like the Uber, like the Apple, like the Nvidia, that we can see the tokens being sold to us. So these are the types of stocks that we like to see growth, that the consumer is driving the demand. Okay, and what's expectation? Okay, expectation is 20% annual CAGR. Okay, my expectation this year is 20%. Okay, I've already exceeded that. I knew that's 20% because I want to redefine my Nvidia a bit more. I'm not in a rush, but building and scaping the portfolio after so many years of growth. Because 20% means every 3.6 years you double in your portfolio. Okay, you double 3.6 years. Okay, 20%. That's all you need. If your portfolio hits 20% every year, you double every 3.6 years. And it doesn't count the fact that you actually still did all cost averaging in. And then you got more time, you spend more time managing the 30% of the stocks. Remember, 70%, you know the top 3, you know your 3 strikers here. But the other ones, you just buy, and you hear about AppLovin, you hear about Sterling, you hear about Open, or buy a bit here, buy it. You spend more time fiddling about the last 30%, but the top 3 is just there locked in. And you know when you need to go big, you go big. Okay? It's concentrated. It's been criticized many times. It's been criticized. But it's safer than an all-in stock. And it's safer because there are loads of other growth stocks that you can choose out there. Even if you choose any Mag 7 stocks as your top 3 back from 2015 or back in COVID, you'll be up beating the market. So easy. So easy. Okay? That's all I can say. And you focus on the small bags and boring stocks under 30%, but it makes it even fun, is it? But if you do not want to, focus on the top 3. The only biggest problem with this type of top 3 portfolio, I can assure you, okay, we're not Buffett, remember, is less cash. I'm always 99.9% invested. I'm always 95% invested in. Very rare I get a 5% cash from a bonus or from somewhere, or something that I've sold, or something I've made an investment out somewhere. And very likely, because the cash is all in, because the 3 stocks I buy it's running and gunning, and I cannot wait for, you know, the perfect buying. I have to DCA in sometimes. So this is my style of the top 3. This is then, and previously I shared the other 10% rule style that is more like Peter Lynch and more for disciplined, very organized people. And pick and choose what you want, folks. This is a different style, and this is my raw edition of portfolio diversification. And I hope you guys found that useful. And I'm gonna go and look at any questions and comments that I can help you guys with, because hey, we're live, and that's the benefit of going live with me. And remember, on the club, I go live with my members at least twice a week, and sometimes if I got a workshop or anything new that I'll share, I'll do a couple of sessions with them. And this was an hour session which I shared them the last few weeks, and thought I'd give it to you guys, for free, just to help you guys guide into the regime here. Okay, I am looking at the questions. I am using I guess people are going off the lunch, moving off soon. I see a question. Sadiq, colleague, how are you doing? No problem. I hope you've learned something. And Adrian, how are you doing? Thanks for coming. I think Adrian is one within my club members, and I've known Adrian for years as well on YouTube, my YouTube journey. So thank you for the support here, Adrian. Appreciate this. And I am looking at Ishad Murad. Thank you very much. I'm seeing a comment. There's a little crown on the top. It says number 3. I'm not sure what that means on YouTube. I've not been here a while, but I'm going to read your question. What do you guide beginner for picking the right stocks, and how can a beginner come over the fear of stock going to delist? Okay, that's easy. Okay, I think I've got the answer in my head already. Okay, once and foremost, being it's not about being beginner. Don't, you're not a beginner no more. You're in the investing market, you're investing, you understand what I can feel that you're asking the questions you ask. I can feel that you're already not a beginner. Okay, it sounds like fear of stock going delist. You've gone through a hard path. Okay, I've gone through a hard path during investing. I've lost a lot of money, almost lost my family. Okay, there's a story to tell another day. But all I can tell you, my friend, is don't fear the fear. Okay, let me explain to you how. Okay, for one, fear of stocks going delist. Okay, so like I said just now earlier on, you can buy high risk stocks. Okay, but make sure that you do not more than 10%. Okay, if you are worried about stocks that delist, okay, this type of stock that delist, then don't go for the bigger companies that are making profit. Companies that get delisted, the companies they break the rules that are normally foreign. Okay, if you're in the US market, the delisted stocks are always the Chinese stocks because politically they disagree with one another and get delisted. Even if there was an American stock in China, if something happens, they get delisted because so avoid those political type stocks. Avoid those stocks that are not making profit, and avoid those stocks like a plague if the ones that break the rules. Okay, I've seen the likes of Twilio not playing the rules, made a blunder in their earnings, and the stock dropped. And now Twilio, is nobody trusts the CEO no more. It's going low. And your MSCI type stocks, your Taiwanese equivalent of Dell, not sending the submission in time and getting punished every time. So those stocks that get delisted are those naughty companies. Very easy to spot. If a company breaks the rule, that means they're not spending enough in that management layer to get things right. If they don't do that, if they don't get management layer right, they're not going to get products right. So I avoid. Okay, delisting you can avoid, but if you are worried about all this, never go beyond 10%. Okay, and to answer your questions on beginner's guide for picking the right stocks. Okay. In the beginner's guide, I mean, if you're starting from scratch, this is the part. You pick stocks within this area. Okay, you pick stocks within this area. You pick this stock within the staples and mature growth sector. Okay, build the staples, build the feeling, give the confidence, build the staples, build the index. Okay, start grounds up. When I built my kids' portfolio between the age of 1 to 5, yes, I invest since the day they were born. 1 to 5, it was purely staples. It was that confident building, the understanding of the market. I built the index. I bought lots of index. I bought lots of very, very defensive shares. And then I start mature. And to find the right, to pick top stocks like high risk and high growth, it takes a bit of a substantial experience and reading the right materials. Okay, you can go to Morningstar. Okay, I'll show you. You can go to Morningstar, and all they tell you is stocks you do not want to hear. No, that's not Morningstar. That's a different Morningstar. Morningstar investment. Yeah, you can go to Morningstar. People pay Morningstar, and the stocks and stuff they tell us are basically stocks that are found in this category 3 and 4. Okay, they don't tell you 1 and 2 because these companies fear on this 1 and 2. And guess, if you go to Twitter and X, they tell everything on high risk stocks. They tell you everything. Everything is money is flying out of the sky. So you just need to find the balance. Go to Morningstar. Go to Morningstar website if you're looking for number 3 and number 4. The high risk and high growth stocks the high risk stocks you'll find it in Twitter. Everybody speaks about it, speculative. The challenge is finding the high growth stocks. Okay, for you today, I'm going to do a filter. I'm going to help you. Okay, I am going to help you. You can take a screenshot here. Okay, I'm going to zoom. This is my high risk stock. This is what I shared with my members this morning. Okay, I'm going to help you. This is what I am sharing. So for the high risk stocks, you have, this is my high risk list just now. Okay, only 2 buytrigger, Eli Lilly and New Holdings and Uber is still on value trigger. So take a screenshot, and I hope this helps you, Irshad Murad. Okay, and as always, you're welcome to the Buy Trigger Club. I can promise it's helped a lot of people, and I'm sure will help you guys. But if not, my threads and my newsletter will help on the weekly, daily basis. Okay. I'm looking at the next question from a very good looking guy here on this picture called Vansh Malik. Okay. Hello, sir. So the list of your top 3, is it dynamic with the market condition, with active relocation, or is it something that you have trust in for a foreseeable future, 5 to 7 years at least? Smart question from a very, very smart fella here, Mr. Malik. Okay. Thank you very much for the question. So the top 3 is dynamic condition. Yes, of course. You can pick the top 3, okay? Top 3 can be selected based on what you believe. You can be from, it depends on where you come from geographically. So top 3 you might be from Asia, Taiwan, you see things. So top 3 of the stocks is what is staple to you. Staple meaning the company that will be going on and on. So if I were growing up in, when I was in university in 2000, and if I was to be picking a top 3 back then, yeah? Okay, 2000 back then. What was the wave? What was the cool stuff in 2000? 2000 we had companies like Vodafone, Shell, BP, BMW. Those were the growth stocks in 2000. Okay, those were the stock to buy because you can see BMWs popping everywhere. People can afford cars, the loans. Vodafone, 3G, 4G popping out everywhere. Those were the trend back then. So you look at now what's the trend today. So today, if you're starting, the trend would be the AI stocks, the AI infrastructure stocks. Okay, the fintech companies, the new holdings, the Revolut that you hear every single day. You're not going to buy HSBC today, but back in 1999 and 2000, HSBC was the hot stocks. So you pick what you see in the trend today, and you don't necessarily have to go all in, but once you find something concrete that you really like, you go in. I found Apple in 2015. I bought in 2012, but I noticed that Apple was dropping. I knew that the handover from Steve Jobs to Tim Cook wasn't healthy, but that was the opportunity. That was the moment, the one in a decade moment to buy in Apple. Okay, that was the moment. So you find your moment. My friend found his moment in Netflix in 2009, 2010, 2011 when Netflix crashed, and he could see the market was crashing, but Netflix was growing in numbers. It was in your remote control. So that's why you focus on that top 3 companies. See, what you see is going to be the next big thing. For me now, as I stand today, when I speak to my kids, I say, look around, look at Uber. Okay, when I do my business trips, look at the number of black cabs that's sitting there, and look at the queue on Uber. People are fighting over queue on Uber. So look around. It doesn't have to be in the profit and loss segment. Look around on what's impacting. If I was in Brazil today, I'll be looking at Nubank. Brazil Nubank is a Sterling or Revolut equivalent to us today. And if I was Brazilian, I'll be buying Nubank as my top holding. Why? Because Nubank is growing bigger than the national bank just now. And you live in Brazil, you see it. So for you, my friend, where you grow, where you see, find that gem. It doesn't need to be Nvidia. It doesn't need to be Meta, Facebook. It depends on where you are. But you need to understand the company. I hope you understand that. And yes, 5 to 7 years. It could be even 15 years, my friend. Okay? It could be 15 years. And look at Netflix. 15 years is gone over almost 50 times. Imagine you put in 10,000. Netflix will be $1 million stocks if you start in 2010. Okay? Thank you very much. I appreciate that. I'm looking at Wolf. Hi, Alex. When you look to swap a stock and taking profit, would you then dollar cost average, or if it's a dip bulk buy, or swap situation to diversify? Also, Nvidia. Okay, I'll put the Nvidia at the bottom because I want to answer that. Okay, but I want to answer your question on swap a stock and taking profit. Would you dollar cost average if you? Okay, so it depends how you swap a stock. Okay, there's two swapping stock scenario here. So swapping stock meaning that if you think the company is gone, I call it the risk transfer. Okay, if I think let's say company A is not doing well, I'm down 20%. I risk transfer. I swap that 20% loss to another stock that's down 20%. Okay, for example, Tesla. Not Tesla. Tesla is a bad one. Okay, let's say United Health. Okay, if I bought another company down 20%, but I know United Health is going to upset 20%, I risk transfer. That's fine. I hope that's clear. Yeah. But to answer the question on the profit taking, is when you swap a stock and take profit, then so I'm trying to understand. So if I were to swap a stock, I will swap it fully. Okay, let's say I'll swap it fully, risk transfer fully. If I've profit, let's say you've got Robinhood, like what I did Robinhood. Okay, I have 10x. I could trim my profits, but because the other stock I wanted to buy was really, really cheap, so I cut 100% and move. I could have allocate, but I needed my concentration to be huge, so I moved the entire chunk to make sure the concentration works. And if you dip bulk buy, so I will only dip bulk buy on two conditions. Okay, two conditions. Listen, hear me out here. One, the VIX needs to be over 24. Yes, the VIX. If you don't know what the VIX is, it's this chart, VIX stock. Okay, VIX is the volatility indicator. I only two conditions. When the VIX is over 22, okay, means everybody is selling, everybody's panicked, the volcano is erupted, and guess what? You're out there shopping for gold. Okay, the second condition that I'll buy in bulk is when the buy trigger is in place. Okay, I bought lots of Nvidia when the VIX was high and the buy trigger was cheap, and I knew that it was the lowest point, the best maximum risk reward. And this is when you go big and you definitely go home. Okay, I hope that helps, Wolf. Appreciate that. And Vansh, thank you very much for your question. Wolf, thanks very much for your question, guys. I appreciate this. So I'm looking at the watch, it's 45 minutes, and I've taken a lot of your lunchtime, but I hope this has helped everyone in this segment here. And hopefully, follow me on Threads. That's where I am. Sign up on my weekly newsletter. That's where I spend lots of time on a Sunday to share it with you guys. And then hopefully, this is not a journey that will happen just overnight, guys. This is a journey that will grow over time. And I hope this portfolio growth optimization is useful for you guys. And engage, ask questions on Threads. I'm always there to help as much as I can. And okay. Have a good day, guys. Take care. Appreciate your time and go enjoy your lunch. Bye-bye. Bye-bye.